Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, one question, and a great question, wouldn't it be better to double the number of contracts instead of widen the spread and you'd get more premium? Well, you know what? There's a number of different ways that you can implement this particular strategy. You could do 10 contracts between 102 and 101. You could then say, okay, I'm going to collect less premium at a higher strike, and you could add, if you're say you had an ultimate capital outlay of $2,000, you could say, okay, I'm going to buy 10 of the sell 10 of the 102, 101 strike puts, and then I'm going to drop down and I'm going to do I'm going to sell 20 of the 199, depending on what credit you're receiving. But the idea is that you're going down to a lower strike combination, whereby the probabilities of them expiring are much higher, and you're using part of the capital that you decided that you were going to risk on a position that has a higher probability of expiring worthless. So that if your first position here is threatened, well, then ultimately and ideally, your second position at the lower strikes were going to come in, and it's going to offset some of this risk exposure. At the end of the day, you still have a maximum risk exposure of $2,000 in that scenario. The idea is that you can combine these different strategies a number of different ways. In fact, the Iron Condor is a prime example of just simply taking a call credit spread and a put credit spread and surrounding a particular security that is range-bound, and you've essentially taken the information that we've talked about here tonight, bull put spread, bear call spread, and you've now made it an advanced strategy, right, depending on your outlook. So many different ways that you can implement these strategies. In fact, that strategy as well is very effective trading the FX options, again, simply because of the way these pair values very much respect their support and resistance levels, apart from some of these day-to-day anomalies that we see like last Thursday. But they, under normal circumstances, we see these pair values very much in the bigger picture respecting their support and resistance levels, which means that we can get in and implement some of these more advanced strategies a little more effectively. Now, just to kind of, once again, kind of follow through and carry on with this particular example, you can see here that our maximum profit is determined by taking the short call credit, in this case, put credit, and subtracting the long put debit. So in other words, we receive $270 for our 10 for the combination that we've created here, while risking $730. Now the idea is that as long as the pair value stays at or above 102, then we're going to make our full the full credit on this particular position. So just to summarize, guys, because I know, once again, the margin requirement, just to follow up with that as well, margin requirement is determined by taking the spread differential, which is 1 point, subtract the credit that we've received, so you can see the spread differential is $1 or $100 for each one contract, minus the 27 cents or $27, gives us $73, and then of course we multiply that by 10, and our maximum risk exposure, our margin requirement, becomes $730. So important considerations. Don't ignore the technicals. The most successful credit spreads implemented, in my opinion, are credit spreads where these key support and resistance levels are taken into consideration, where you're either using just a very simple approach to identifying those levels by looking at areas where the pair values are consolidating and where where the price points are being respected, or you're using Fibonacci. Some people like to use Bollinger Bands, measuring standard deviation, whatever it is. And of course, we didn't get into that tonight, a little more advanced. But the idea is that we need to look at our price charts and establish some important levels before we consider creating the actual credit spread. Remember that near-term options will expire faster. So ultimately, we really don't want to give the person that purchased that call or put option from us an opportunity to be right. And the way that we can cap that is by not giving them enough time. So once again, and I know we have a lot of folks online that come through our program, remember that we just have a simple rule. When you're buying options, give yourself time, because when you're a buyer, you need to put the laws of probabilities on your side more effectively, right, to make sure that you have a higher probability of being correct. But as an option seller, you don't want to give the buyer that opportunity. So you want to try to collect as much premium as you can, but in the taking advantage of the shortest time frame possible, because that ultimately means that those options are going to expire worthless, and that rate of time depreciation is going to kick in much more faster, allowing you to profit more quickly. Now, the closer the strike intervals, the less margin requirement. So essentially what I did is I obviously illustrated the importance of recognizing that different securities are going to have different strike intervals. And what I find one of the attractive characteristics about these ISE FX options are those nice little tidy strike intervals on the option contracts. Because what that means is that I can go in, and if I can get a decent premium for a combination with a 50-cent strike interval, that means I put up less capital and I can create more of them, or I can, whatever considerations I'm going to make at the time, I can do it. I can also say, well, you know what, I'm prepared to widen out that strike interval because ultimately I'm collecting a greater premium, so I'm prepared to take on a little bit more risk because I'm getting a more attractive premium for that risk.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.